Hello and a very warm welcome everyone to Chapter 8 of FIN552, Investment and Portfolio Analysis. Today, we begin one of the most practical and exciting topics in the whole course, equity portfolio management strategies. Now, the word equity simply means shares or stocks in a company. When you own equity, you own a small slice of a real business listed on a stock exchange like Bursa Malaysia here at home or the New York Stock Exchange in the United States. A portfolio is just a collection, a basket of these shares held together, and a strategy is the deliberate plan a professional manager follows to decide which shares go into that basket and when to buy or sell them. So when we put it all together, equity portfolio management strategies is really about the different game plans that fund managers use when they invest billions of ringgit of other people's money in the stock market. Over the next set of slides, we will discover that there are two great philosophies in this field. Some managers try to simply match the market, quietly and cheaply. Others try to beat the market, working hard to pick winning shares. Both camps have strong arguments, and by the end of this chapter, you will understand both, and you will even be able to do the key calculations that professionals use to measure their success. I want you to relax because I will define every single term the first time it appears, and I assume you are meeting most of these ideas for the very first time. Let us begin by asking ourselves a simple but powerful question on the next slide. Let me start with a question I want you to actually picture in your mind. Imagine you have just been given 50,000 ringgit and your only task is to invest it in shares on the stock market. You have two completely different roads in front of you. The first road says, do not try to be clever. Simply buy a little bit of every major company in the market and hold them quietly for years. The second road says, no, study hard, find a few special companies that are going to do better than the rest, and put your money there to beat the average. Believe it or not, this one decision splits the entire investment profession into two camps, and almost everything in this chapter flows from it. On the screen, you can see the four big ideas we will explore. The first is passive management, which means buying the whole market cheaply and just holding on, like buying the entire fruit basket instead of picking individual fruits. The second is active management, which means actively hunting for winning shares in the hope of beating the market average. The third idea is tax efficiency, which is about how much of your hard-earned return you actually get to keep after taxes take their slice. Because in investing, it is not what you make, it is what you keep. And the fourth idea is investment style, where we ask whether you are a value investor who loves a bargain or a growth investor who chases fast-rising companies. Keep these four cards in the back of your mind, because they are the map of our entire journey. Now, before we dive into the theory, let us look at who actually uses these strategies in the real world, because you might be surprised at just how much money is involved. Before you dismiss any of this as dry textbook theory, I want you to see just how real and how enormous this topic is. Every strategy you will learn this semester is being used right now to manage trillions of ringgit by institutions whose names you already know. Look at the first column, the passive or index giants. Here in Malaysia, the Employees Provident Fund, which we call the EPF or KWSP, looks after the retirement savings of millions of Malaysian workers, and a large part of that money is invested to simply track the market cheaply rather than gamble on individual stocks. An index, by the way, is just a basket that represents a whole market, and tracking means trying to copy that basket's performance. Globally, Vanguard is the company that pioneered this low-cost index approach, and BlackRock, through its iShares brand, runs the biggest collection of index funds called ETFs anywhere in the world. In the middle column, we have the active stock pickers, the managers who believe they can beat the average by carefully choosing shares. In Malaysia, firms like Kenanga Investors and Affin Hwang Asset Management actively select Bursa Malaysia shares hoping to outperform the main index, the FBM KLCI. Globally, Fidelity built its reputation on star managers who picked winning stocks. And in the third column, we see style and pension funds, the long-term giants like KDWAP, the pension fund for government servants, Tabung Haji, ASNB, which manages the famous ASB fund, and globally PIMCO, all of whom blend different investment styles to grow their members' money steadily over decades. The key lesson here, and it is on your goal takeaway box, is simple. Different institutions chase different goals, and because their goals differ, they deliberately pick different equity strategies. There is no single right answer, only the right strategy for a particular objective. Now that you can see how real this is, let us set out exactly what you will be able to do by the end of this chapter. Let me tell you exactly where we are going, because knowing the destination makes the journey much easier. These are our 6 learning outcomes for the chapter. And notice that each one carries a little gold tag with a code like C2 or C3. Those codes come from Bloom's taxonomy, which is simply a ladder of thinking skills, from remembering facts at the bottom, up to understanding, then applying, then analyzing. I show them so you know how deeply you are expected to master each idea. The first outcome is to distinguish the goals of passive versus active equity managers, an understand level outcome. The second is to compute and interpret a portfolio's tracking error. The word compute is important. This is an apply level outcome, which means there will be a calculation, and I will walk you through every step. The third is to describe the techniques used to build an index portfolio and the products, index funds, and exchange-traded funds that deliver them. The fourth is to explain the fundamental, technical, and anomaly-based strategies active managers use to seek alpha. The fifth is to measure the tax efficiency of an actively managed portfolio. Again, an apply-level outcome with real formulas. And the sixth is to differentiate value from growth investing and explain why investment style matters. An analyze level outcome where you compare 2 schools of thought. Here is your exam tip in the goal box. 2 of these outcomes are at the apply level, tracking error and tax efficiency. And that tells you exactly where the calculation questions will come from. So pay very close attention when we reach those slides. Now let me show you the roadmap of how all of this fits together. Here is the map for our whole journey today. 6 clear stops, and we will travel through them in a deliberate order that builds your understanding step by step. Stop number 1 is total return, where we break open a portfolio's return and see exactly what it is made of, because you cannot judge any manager until you understand what a return actually contains. Stop 2 is passive versus active management, the great fork in the road, the single most important distinction in this chapter. Stop 3 takes us deep into passive management, where we learn how managers build a portfolio that copies an index, and how we measure how well they copied it using a number called tracking error. Stop 4 is the mirror image, active management, where managers try to beat the market using fundamental research, technical signals, and market anomalies. Stop 5 is tax efficiency, a quiet but powerful idea about how taxes eat into returns and how we measure that drain. And our final stop, stop 6, is investment style, the famous contest between value investors who hunt for bargains and growth investors who chase fast rising companies. Notice the logic of the order shown by the gold arrows. We first understand what a return is, then we choose a philosophy. Then we master both philosophies in detail. Then we learn to keep more of our return after tax, and finally we pick a style that suits us. Each stop prepares you for the next. So let us begin at the very beginning with stop number 1 and ask the most basic question of all. What is a portfolio's total return really made of? Welcome to section 1, Total Portfolio Return. Before we can sensibly compare passive and active managers or judge whether anyone is doing a good job, we first have to answer a very basic question: what is a portfolio's return actually made of? It turns out a return is not a single lump. It can be split into a part that the market gives to everyone and a part that the individual manager personally added. Understanding that split is the foundation for the entire chapter, so let us start right there. Now we arrive at our very first real concept, and it is the foundation for everything else, so let us take it slowly. The question on the slide is, what is a portfolio's total return actually made of? When you invest and your money grows, where does that growth come from? The answer, and you can see it in the tinted box at the top, is that your total return is really just two things added together. The first part is the return the market hands to everybody who invests, and the second part is the extra bit, which can be positive or negative, that your particular manager personally added through their skill. Let me give you the formal definition. The total actual return on any equity portfolio can be decomposed, which simply means broken down, into its expected return and its alpha. Let me define each of these terms because they are brand new. Expected return is the baseline. It is what the market is expected to give you for the level of risk you took, and anyone investing in the same way could earn it. That expected return itself is made of two pieces. The first piece is the risk-free rate, which is the return you get on a totally safe investment, like a Malaysian government treasury bill. And you can think of it as your reward for simply being patient and waiting. The second piece is the risk premium, which is the extra reward investors demand for taking the risk of holding shares, which can go up and down, instead of safe assets. Then comes the star of the show, alpha, written as the Greek letter that looks like a fish. Alpha is the manager's personal value add. If a manager produces positive alpha, it means they beat the market and earn their fee. If alpha is negative, it means they actually lag behind what you could have gotten for free. So remember the goal takeaway. Total return equals what the market gives everyone, plus alpha, what the manager personally added. On the next slide, I will show you this exact idea written as a clean formula with real numbers so you can see it work. On the previous slide, we said total return is the market baseline plus alpha. Now let me show you that exact idea written as a clean, simple formula and then prove it with real numbers so it sticks. Look at the box on the left. The first line says total actual return equals E of R plus alpha. E of R, written with the capital letter E and R in brackets, is just shorthand for expected return, the market baseline. And alpha, the Greek symbol, is the manager's value added. The second line opens up the expected return for us. It says E of R equals the risk-free rate plus the risk premium. So if you put both lines together, your total return is the risk-free rate plus the risk premium plus alpha. Underneath, I have listed what every symbol means, so please copy those down. Now let us make it concrete with the example on the right, featuring Mr. Hafiz. Mr. Hafiz's fund earned 11% last year. The safe treasury bill, the risk-free rate, paid 3%, and the fair risk premium for taking share market risk was 6%. The question is, how much alpha did his manager actually add? Let us work it through slowly. First, we find the expected return, the baseline. We add the risk-free rate of 3% to the risk premium of 6%, and that gives us 9%. That 9% is what Mr. Hafiz could have expected just from the market, with no special skill. Now, his fund actually earned 11%. So the alpha, the extra value added, is the actual 11% minus the expected 9%, which equals positive 2%. You can see the final answer in the gold box. Alpha equals plus 2%. And here is the meaning. A positive alpha tells us the manager genuinely beat the market baseline, so they earned their keep. A common mistake students make is to forget to subtract the full baseline. So always remember, alpha is what is left after you take away everything the market would have given you anyway. Now that we understand what a return is made of, we are ready for the big fork in the road, the choice between passive and active management. Now we move into section 2, passive versus active management. This is the great fork in the road, the single most important distinction in the whole chapter, and almost everything else flows from it. On one side stand the passive managers who simply try to match the market as cheaply as possible. On the other stand the active managers who work hard and charge more in their attempt to beat the market. Let us lay these two philosophies side by side and understand exactly how they differ. We have reached the heart of the chapter, the single most important distinction you will learn, the fork in the road between passive and active management. I want you to really understand this contrast because every other topic hangs off it. On the left, in the gold-headed card, is passive management, whose entire philosophy can be summed up in 3 words: match the market. A passive manager follows a long-term buy and hold strategy, which means they buy a basket of shares and simply hold them for years, rarely trading. Their goal is to track a market index, that is, to copy the performance of a basket that represents the whole market, like the FBM KLCI in Malaysia or the S&P 500 in America. Notice the crucial point. They are designed to match the market, not to beat it. Because they do almost no expensive research, their fees are very low, and they are judged purely on how closely they manage to track the index. If the index goes up 10%, a good passive fund also goes up very close to 10%. Now look to the right at active management, whose philosophy is the opposite: beat the market. An active manager actively buys and sells shares trying to find winners. Their holy grail is alpha, that word again, meaning returns above the benchmark. A benchmark, by the way, is simply the yardstick they are measured against, usually a market index. To find alpha, they rely on research, forecasts, and skill, and because all that effort costs money, their fees are much higher, typically 1 to 2% of your money every single year. They are judged on risk-adjusted outperformance, meaning did they beat the market after fairly accounting for the extra risk they took. Hold on to that contrast, because next we go deep inside the passive world to see exactly how it is done. In section 3, we go deep inside the passive world. Having met the philosophy of just matching the market, we now get practical. We will ask why the passive approach is so surprisingly powerful. We will learn the 3 techniques for actually building a portfolio that copies an index, and then we will meet the passive manager's all-important report card, tracking error, including our very first calculation. So roll up your sleeves. This is where passive investing comes to life. So we are now inside the world of passive management. And the first thing I want to answer is a very natural question. Why on earth would a smart investor choose to just copy the market instead of trying to beat it? It sounds lazy, but the argument is surprisingly powerful, and it rests mainly on costs. Look at the first card. Costs are hard to beat. An active manager typically charges you between 1 and 2% of your money every single year for their research and effort. Now think about what that means. For an active manager to actually do better than a cheap passive fund, they do not just need to beat the market, they need to beat it by more than that 1 to 2% fee every year just to break even with the cheap option. Decades of evidence show that the majority of active managers fail to do this consistently. The second card, replicate an index, explains the passive method. The manager simply tries to copy the performance of a chosen market index as closely as possible, with no stock picking guesswork. The third card reminds us there are many indexes to track. In the United States, a manager might track the S&P 500, which is 500 big American companies, or the Nasdaq Composite, which is heavy with technology firms. Here in Malaysia, they would track the FBM KLCI, our main index of 30 large Bursa-listed companies. Now, I must be honest with you, and the navy strip shows the one catch. A passive fund will usually slightly underperform its target index. Why? Because even the cheapest fund still has to pay small fees and commissions, so it always lags the index by a tiny amount. The goal of the passive manager is therefore to lose as little ground as possible. And that beautifully leads us to the next question. How exactly do you build a portfolio that copies an index? Let us look at the three construction techniques. Alright, so a passive manager wants to build a portfolio that copies an index. It turns out there are three different techniques to do this, and each one involves a trade-off between accuracy and cost. Let us go through them one at a time. The first technique, number one, is called full replication. This is the most thorough approach. You literally buy all the securities in the index in the exact index weights. So if a company makes up 3% of the index, you put 3% of your money into it. The big advantage is that this ensures very close tracking. Your portfolio behaves almost identically to the index. But there is a catch, and you can see it in red. Buying every single stock means high transaction costs, and when hundreds of companies pay you small dividends, reinvesting all of them is fiddly and expensive. The second technique, number two, is sampling. Instead of buying everything, you buy only a representative sample of the index stocks, carefully chosen to behave like the whole index. The advantage is fewer stocks, which means lower commissions, and dividends are easier to manage. The disadvantage is that because you do not own everything, your portfolio will not track the index quite as closely. And that small gap is called tracking error, a term we will measure very soon. The third technique, number three, is quadratic optimization, which sounds frightening, but the idea is simple. A computer program takes historical information about prices and correlations, that is, how stocks move in relation to each other, and it calculates the mix of stocks that minimizes tracking error. It is very efficient in theory. The weakness, in red, is that it relies on past correlations, and those relationships can change over time. So the portfolio may suddenly fail to track well. The takeaway ties it together. More precision, like full replication, costs more money, while the cheaper methods accept a little tracking error in exchange for lower costs. And speaking of tracking error, it is so important that it deserves its own slides. So let us define and measure it now. Now we meet one of the two big calculations of this chapter, tracking error, and I promise to make it painless. Think of tracking error as the passive manager's report card. Remember, a passive manager has exactly one job: to copy the index. Tracking error is the number that tells us how well they did that job. As the blue box at the top says, tracking error tells you how far a fund's returns drifted away from the index it was supposed to copy. So a small tracking error means a good, faithful copy, and a large tracking error means the fund wandered off and did its own thing. Now, how do we calculate it? It comes in two steps, shown in the two cards. Step A is to find the return differential in each period. The formula says delta sub t equals r sub pt minus r sub bt. Let me translate that completely. The triangle symbol, delta, just means the difference or gap. R sub pt is the return on the managed portfolio in period t. The little p stands for portfolio. R sub bt is the return on the benchmark index in the same period. The little b stands for benchmark. So for each period, you simply subtract the index return from the fund return, and that gives you the gap for that period. Step B is where tracking error is actually born. Tracking error is defined as the standard deviation of all those differentials. Standard deviation, if you have not met it yet, is a measure of how spread out a set of numbers is. The formula looks busy, but read it calmly. You take each period's differential, subtract the average differential, which is delta with a bar over it, square that, add them all up using the big sigma summation sign, divide by n, the number of periods, and finally take the square root. Notice we divide by n, not n minus 1, and that is the convention we will follow throughout. The result is normally annualized, meaning scaled to a yearly figure. The takeaway, tracking error is just the standard deviation of the gap between fund and index, and smaller is better. Now let us actually do one, step by step, with real numbers. Here we go, our first full tracking error calculation, and I will walk you through every single number so that you could reproduce this alone in the exam. The question in the gold box gives us a manager's returns compared to its index over 8 periods and asks for the tracking error. The table on the left lists each period, the manager's percentage return, and the index's percentage return. Step 1, shown by badge number 1, is to find the differential for each period, which is just the manager return minus the index return. Look at period 1. The manager made 2.3% and the index made 2.7%. So the differential is 2.3 minus 2.7, which equals minus 0.4. A negative number simply means the fund slightly trailed the index that period. We do this for all 8 periods, and you can see the results in the delta column. Now add up all 8 differentials, and they sum to 1.6, shown in the highlighted bottom row. Step 2, batch number 2, is to find the average differential, written as delta with a bar over it. We take the sum, 1.6, and divide by n, the number of periods, which is 8. 1.6 divided by 8 equals 0.2. So on average, the fund beat its index by a tiny 0.2%. Step 3, batch number 3, is the real tracking error, the standard deviation. We take each period's differential, subtract the average of 0.2, square the result, and add all 8 squared numbers together. When you do that arithmetic, the squared deviations sum to 7.02. We divide that by 8 to get 0.8775 and then take the square root, which gives 0.94%. And there is our answer. In the gold box, tracking error is approximately 0.94%. Because that number is small, we conclude this fund copied its index very faithfully. Now please note the exam tip in the takeaway. You must divide by n and you must square the deviations from the average differential, not from zero. That is the most common mistake students make. To lock this in, let us try a slightly harder exercise comparing two managers. Let us cement your understanding with an exam-style exercise, the kind of question you might genuinely face. This time, two managers, A and B, are both compared to the same index over 10 periods, and we are asked two things. First, to find each manager's tracking error, and second, to decide who did a better job of limiting the client's unsystematic risk. Let me pause on that phrase, unsystematic risk. Systematic risk is the risk of the whole market that you cannot avoid. Unsystematic risk, by contrast, is the extra specific risk a manager takes by straying from the index and doing their own thing. Tracking error is precisely a measure of that straying. The method is exactly the same as the worked example, so I will summarize rather than read every cell. For manager A, we compute the differential between A and the index in each of the 10 periods. Find the average differential, which comes to minus 0.11, then sum the squared deviations from that average, getting 40.15, divide by 10 to get 4.01, and take the square root, which gives a tracking error of about 2.00%. We repeat the identical process for manager B. B's average differential is plus 0.38. The squared deviations sum to 80.94. Dividing by 10 gives 8.09, and the square root is about 2.84%. Now, to the second part of the question, who limited unsystematic risk better? The answer is in the navy box. Manager A's tracking error of 2.00% is clearly lower than Manager B's 2.84%. Because a lower tracking error means the manager stayed closer to the index and therefore took less active, unsystematic risk, Manager A did the better job. Notice the subtle point. This is not asking who earned more, it is asking who hugged the index more tightly, and that is Manager A. With passive measurement mastered, let us see the actual products investors use to buy an index, index funds, and ETFs. We have learned the philosophy of indexing and how to measure it. But how does a normal person actually buy an entire index? You cannot exactly go and buy 30 Bursa companies yourself easily. The answer is two clever products shown side by side. On the left are index mutual funds. An index mutual fund is a pooled investment where the manager replicates the index's exact composition and weights, buying the same securities in the same proportions. The manager only changes the holdings when the index itself changes, for example, when a company is added or removed. Because there is no expensive research and very little trading, these funds have low trading and management expense ratios. Expense ratio, a new term, is just the annual percentage fee the fund charges, so low is good. The great benefit is that for a small amount of money, you instantly own a diversified portfolio. And diversified means your money is spread across many different stocks, which lowers your risk because you are not betting everything on one company. One small limitation, an index mutual fund is priced and traded only once a day at its closing value. On the right are exchange-traded funds or ETFs, which are similar but with a powerful twist. An ETF is essentially a basket of securities held by a financial institution, and when you buy a unit, you get a pro rata claim, meaning a proportional share of everything in that basket. The big advantage over a mutual fund is that an ETF can be bought and sold, and even short sold, just like an ordinary share at any moment while the market is open. Short selling, which we will meet again later, means betting that a price will fall. Famous examples include SPDRs, which track the S&P 500, the iShares family, and sector ETFs that focus on one industry. So the takeaway, both products hand you a whole index in a single click, but ETFs add the freedom to trade throughout the day. That completes the passive world. Now we cross over to the exciting, competitive world of active management. Welcome to Section 4, Active Equity Management, the energetic, competitive opposite of everything we just learned. Here, managers are not content to match the market, they want to beat it, and they have developed a whole toolbox of strategies to try. We will first see why beating the market is so much harder than it sounds, and then explore the three great families of active strategy: fundamental analysis that studies the business, technical analysis that studies the price, and the hunt for market anomalies. Let us see how the alpha hunters work. We now cross over from the calm world of passive investing into the energetic, competitive world of active management. Remember, active managers believe they can do better than the market average, and this slide lays out their goal, and importantly, why that goal is so devilishly hard. The goal itself, in the navy box on the left, sounds simple: earn a return that beats a passive benchmark after transaction costs on a risk-adjusted basis. Let me unpack that carefully, because every word matters. A benchmark is the yardstick, usually a market index like the FBM KLCI. After transaction costs means we count the commissions paid every time the manager buys or sells. And risk-adjusted means we fairly account for how much risk they took to get their return. Because earning a high return by gambling wildly is not Jen's skill. Now, why is this so hard? Look at the card below. First, trading costs eat into returns. Every single buy and sell pays a commission, and active managers trade a lot. Second, taking higher risk to chase returns can backfire spectacularly. Third, the manager must pick the right benchmark to be judged fairly. An unfair benchmark flatters or punishes them. The right side dramatizes this as the active manager's hurdle, a set of three stacked obstacles they must clear to truly win. Hurdle 1, they must beat the market's raw return. Hurdle 2, on top of that, they must also cover the 1 to 2% annual fee they charge. And hurdle 3, they must justify the extra risk they took on. Only after clearing all three can they say they genuinely added value. This is the key takeaway: active managers do not just need to beat the market. They must beat it by more than their fees and their risk combined, which is why so few succeed consistently. So how do they actually try? They use three families of strategy, and we will explore each. Let us begin with fundamental strategies. The first and most traditional family of active strategies is called fundamental strategies. The word fundamental simply means you judge a share by the real underlying health of its business, things like its earnings, the strength of its industry, and the state of the economy. It is the opposite of just looking at the price chart. Now, within fundamental analysis, there are two opposite directions you can travel, and they are shown side by side. On the left is the top-down approach, which starts with the big picture and zooms inward, like looking through a telescope and slowly focusing. The top-down manager first decides on broad country and asset class allocation. For example, how much to put in Malaysia versus the United States, or in shares versus bonds. Then they decide which sectors or industries to favor. Maybe they like technology and dislike property this year. And only at the very end do they pick the individual shares within those favored sectors. So the logic flows: economy, then sector, then stock. On the right is the bottom-up approach, which does the exact reverse and frankly ignores the big picture. A bottom-up manager selects shares with no initial market or sector analysis at all. Instead, they hunt company by company, looking for shares they can buy at a substantial discount to what their own valuation model says the share is truly worth. In plain terms, they are bargain hunters who do not care what the economy is doing, they just want a cheap, good company. The takeaway captures it. Top down zooms from economy to sector to stock, while bottom up ignores the big picture and simply hunts cheap individual stocks. Whichever direction they travel, fundamental managers tend to express their ideas through three classic themes, which we look at next. When a fundamental manager wants to actually put their research to work, they typically choose one of three generic themes, three classic plays for trying to beat the market. Let me walk you through each card. The first theme is market timing. A market timing manager tries to forecast where the whole market is heading and shifts money into and out of stocks, bonds, and treasury bills accordingly. The dream is to sell your shares just before a crash and buy them back just before a rally. It is enormously profitable if you get it right and enormously damaging if you get it wrong, which is most of the time, so it is risky. The second theme is sector rotation, and you can think of this as moving your money around the different neighborhoods of the market. Instead of timing the whole market, the manager shifts funds between different sectors, like technology or finance, or between different investment styles, such as value versus growth, or large companies versus small companies, as economic conditions change. For example, when interest rates rise, banks often do well, so a manager might rotate into banking stocks. This is the most common of the three and is literally called the sector rotation strategy. The third theme is stock picking, the purest form of active management. Here, the manager ignores grand forecasts and instead examines individual companies one by one, hunting for specific undervalued stocks that the market has mispriced. The logic is simply this is a good company and it is currently cheap, so I will buy it. Each card also shows a little gold example sentence to make the idea concrete. The takeaway sums up your three routes to alpha: time the whole market, rotate between sectors, or pick individual stocks. Now, modern managers have an even more aggressive tool that combines stock picking with leverage, and it has a memorable name, the 130-30 strategy. Let us see how it works. Here is a strategy with a catchy name that often appears in exams, the 130-30 strategy. The name refers to the split 130% long and 30% short. Let me explain what that actually means, because it involves a new and important idea, short selling. Normally, when you invest, you buy a share hoping it goes up. That is called going long. Short selling is the opposite and slightly mind-bending. To short a share, you borrow it from someone, sell it immediately at today's price, and plan to buy it back later. If the price falls as you predicted, you buy it back cheaper, return it to the lender, and keep the difference as profit. So, with short selling, you actually make money when a stock goes down. Now look at how the 130-30 splits on the left. The manager puts 130% of the capital into long positions, shares they expect to rise, shown by the big green bar. At the same time, they short 30%, betting against shares they expect to fall, shown by the small red bar. Here is the clever bit. The cash raised by short selling, that 30% is used to fund the extra 30% of longs. So the net market exposure is 130 minus 30, which equals exactly 100%. On the right, we see the consequences. Short selling creates leverage, which means it magnifies both gains and losses, like using a bigger lever. It lets the manager make full use of all their research, not just buying the shares they love, but also profiting from the shares they think are overvalued. The result is a higher expected return, but also higher risk than the plain benchmark. So the takeaway, 130-30 is 130% long plus 30% short, giving 100% net exposure with extra firepower from both the manager's best and worst picks. That completes fundamental strategies. Next, we look at a completely different philosophy, technical strategies, which ignore the business entirely. We now leave fundamentals behind completely and enter the world of technical strategies. The defining feature of technical analysis is that it does not care what the company actually does. It does not look at earnings or products or management. Instead, it studies only the past price and trading behavior of the stock to predict its next move on the belief that price patterns repeat. Within this world, there are two famous and opposite strategies shown side by side. On the left is the contrarian strategy, whose motto is do the opposite of the crowd. A contrarian believes the best time to buy a stock is precisely when most other investors are the most bearish, that is, the most gloomy and pessimistic about it. And the best time to sell is when everyone is most bullish, meaning excited and optimistic. Two ideas support this. The first is mean reversion, the notion that prices which have overshot, either too high or too low, tend to drift back toward their normal average level. The second is the overreaction hypothesis, the idea that crowds get emotional and push prices too far in both directions, creating opportunities for the calm contrarian. On the right is the price momentum strategy, which is the exact opposite mindset. A momentum trader focuses only on the trend of past prices and assumes that recent trends will simply continue. So a rising stock will keep rising and a falling stock will keep falling. The motto here is ride the trend. Notice the beautiful contradiction. The contrarian bets that trends will reverse, while the momentum trader bets that trends will continue, and both have made people rich and poor. The takeaway, contrarians bet against the crowd expecting a reversal, while momentum traders bet with the trend expecting it to continue. Finally, there is a third group of active ideas based on repeatable market patterns called anomalies, and we turn to those now. The final family of active ideas is built around factors, anomalies, and attributes. And to understand it, you first need the word anomaly. An anomaly is a pattern in stock returns that, in theory, should not exist if markets were perfectly efficient and priced everything correctly, and yet it stubbornly keeps showing up in the data. Active managers love anomalies because each one is a little crack in the market they can try to exploit. The slide shows three groups. The first is earnings momentum. Earnings, by the way, means a company's profit, and earnings per share, or EPS, is that profit divided by the number of shares. Earnings momentum is measured as the difference between a company's actual EPS and the EPS that analysts expected. The strategy is to buy stocks whose earnings are accelerating and beating expectations, and to sell or short stocks with disappointing earnings, on the belief that good news tends to be followed by more good news. The second group is calendar anomalies, patterns linked to the calendar itself. The weekend effect notes that returns behave differently around Mondays and Fridays. The January effect observes that small company stocks have historically tended to jump in the month of January. These are odd but real enough that people study them. The third group is firm-specific attributes, characteristics of the company. Historically, firm size has mattered. Smaller firms have on average out-returned larger ones, a pattern called the size effect. And firms with low price-to-earnings ratios, return PE, which is the share price divided by earnings, and low price to book value ratios, PBV, which compares price to the company's net asset value, have tended to deliver higher returns. I have defined those ratios for you at the bottom of the slide. The takeaway is genuinely important for the whole chapter. Markets are not perfectly efficient, and these small, persistent patterns give active managers something real to exploit. That wraps up active strategies. Now we turn to a quieter force that erodes active returns, tax. Section 5 turns to a quieter but very real force, tax efficiency. So far, we have talked about earning returns, but in the real world, it is not what you earn that counts. It is what you keep after tax. Every time an active manager sells a winning share, the taxman takes a slice, leaving less to reinvest. In this section, we will learn why this matters so much for active managers, and we will meet our second and third calculations, portfolio turnover and the tax cost ratio, which let us measure exactly how tax-friendly a fund really is. We arrive at our second calculation topic, tax efficiency, and it is a subtle but very important idea, because in investing, it is not what you earn that matters, it is what you keep after tax. This slide explains why active managers in particular must keep a careful eye on taxes. Here is the core problem, shown in the blue box. Whenever you sell a share at a profit, you trigger something called capital gains tax, which is a tax on the gain you made. The moment you pay that tax, there is less money left inside the fund to reinvest, so your future growth is starting from a smaller base. Follow the flow across the four navy boxes. First, the manager sells a winning share. Second, that sale forces them to pay capital gains tax. Third, there is now less money left to reinvest. And fourth, this is the crucial consequence, the new share they buy with what remains, the replacement security, must earn a higher return than the original would have, just to make up for the tax that was paid. In other words, selling is not free. It has a tax cost that the next investment must overcome. The card at the bottom adds the detail of what determines how big that hurdle is. It depends on two things: the expected holding period, that is how long you plan to hold the new share, and the cost basis of the original share. Cost basis is simply the original purchase price, and it matters because the taxable gain equals the sale price minus that cost basis. So a low original cost means a big taxable gain and a bigger tax bill. The takeaway: taxes are a genuine cost of trading, and a smart active manager must clear that tax drag before a sale is really worthwhile. Now, how do we actually measure how tax-friendly a fund is? There are two measures, and we take them one at a time, starting with portfolio turnover. The first measure of tax efficiency is portfolio turnover, and it answers a simple question: how much of the portfolio did the manager buy and sell during the year? The formula, in the box on the left, is wonderfully simple. Turnover equals security sales divided by average AUM, then multiplied by 100 to make it a percentage. Let me define AUM, because it appears a lot in finance. AUM stands for Assets Under Management, and it is just the total ringgit value of all the money a fund looks after on behalf of its investors. So the formula takes the value of shares the manager sold during the year and compares it to the total size of the fund. Why does this measure tax efficiency? Because every sale potentially triggers a taxable gain. So a fund that sells a lot, a high turnover fund, is creating lots of taxable events, while a fund that rarely sells, a low turnover fund, is much more tax friendly. The navy box gives you the interpretation, and this is an exam favorite. High turnover means lots of trading, which points to an active fund. Low turnover means a buy and hold approach, which points to a passive fund. So turnover is also a clever clue to whether a fund is active or passive. Let us do the example on the right, featuring Puan Aisha. Her fund sold 37.2 million ringgit of shares this year, and its average AUM was 289.4 million ringgit. We simply divide 37.2 by 289.4, which gives 0.129, and multiplying by 100 gives 12.9%, shown in the gold answer box. Because only about 13% of the portfolio changed hands in a whole year, this looks like a low turnover, passive fund. The takeaway, turnover equals sales divided by average AUM, and high turnover signals an active fund, while low turnover signals a passive one. Now to the second, more direct measure of tax efficiency, the tax cost ratio. The second and more direct measure of tax efficiency is the tax cost ratio, and unlike turnover, which is only a clue, this number tells you exactly how many percentage points of your return were swallowed by tax. The formula is in the box on the left, and it looks a little intimidating, but it is really just comparing two returns. Tax cost ratio equals 1 minus, in brackets, 1 plus tar, divided by 1 plus PTR, all multiplied by 100. Let me define the two new abbreviations. PTR stands for pre-tax return, the return the fund earned before any tax was taken out. TR stands for tax-adjusted return, the return that actually remained after tax. So the formula is measuring the gap between what you earn and what you kept, expressed as a percentage of return loss. The navy box tells you how to read the answer, and again, this is exam critical. A lower ratio means fewer points were lost to tax, so the fund is more tax efficient, which is good. A higher ratio means more of the return was surrendered to the taxman, which is bad. Let us work the example on the right. A fund had a pre-tax return of 9.98% and an after-tax return of 9.43%. We plug into the formula. 1 plus the tax-adjusted return is 1.0943, and 1 plus the pre-tax return is 1.0998. We divide 1.0943 by 1.0998, subtract that from 1, and multiply by 100, which gives 0.50%, shown in the gold box. So only half a percentage point of return was lost to tax, which makes this a very tax-efficient fund. Notice a quick mental check. The smaller the gap between the pre-tax and after-tax returns, the smaller the tax cost ratio, and the happier the investor. The takeaway, the tax cost ratio is the slice of return that tax took, and lower is better. Now let us put both measures together in a proper exam exercise with 4 funds. Now let us bring everything in this section together with a full exam-style exercise involving 4 different equity mutual funds, labeled W, X, Y, and Z. Take a moment to study the data table on the left, because reading the table correctly is half the battle. For each fund, we are given its average assets under management over the past 12 months, the value of securities it sold over those 12 months, its expense ratio, its pre-tax return, average over 3 years, and its tax-adjusted or after-tax return over 3 years, all in millions of ringgit or in percentages. The required tasks are listed in the gold box on the right, and there are 4 of them. First, calculate the portfolio turnover for each fund. Second, use that turnover to judge which 2 funds are most likely actively managed and which 2 are most likely passive. Third, calculate the tax cost ratio for each fund. And fourth, identify which funds were the most and the least tax efficient. The bottom strip reminds you of the strategy. You will use the turnover formula, sales divided by AUM times 100, for parts 1 and 2, and then the tax cost ratio formula, 1 minus 1 plus TAR over 1 plus PTR times 100 for parts 3 and 4. I strongly encourage you to pause the recording here, grab a calculator, and try all 4 parts yourself before moving on, because the only way to master calculations is to do them. When you are ready, the next 2 slides walk through the complete solution, starting with turnover. Let us go. Here is the solution to the first half of exercise 2, parts 1 and 2, all about turnover. The method is the same for every fund. Divide its security sales by its average AUM and multiply by 100. Let me show you one full calculation using Fund Y in the working box on the right. Fund Y sold 1,453.8 million ringgit of shares, and its average AUM was 1,298.4 million ringgit. Dividing the first by the second gives 1.12, and times 100 is 112%. Pause on how striking that is. A turnover above 100% means Fund Y sold more than its entire portfolio in a single year. It is churning constantly. We repeat the same division for all 4 funds, and the results are in the table. Fund W comes out at 12.9%, Fund X at 86.8%, Fund Y at 112%, and Fund Z at just 7.9%. Now part 2 asks us to use these numbers to classify the funds. The logic, which we learned earlier, is that high turnover means active and low turnover means passive. Looking at the figures, funds X and Y have high turnover, 87 and 112%, so they are the actively managed funds, constantly buying and selling. Funds W and Z have very low turnover, around 13 and 8%, so they are the passive buy and hold funds. You can see this conclusion in the navy answer box. Notice too that the expense ratios in the original table quietly agree with us. The active funds X and Y charge higher fees of 0.71 and 1.13%, while the passive funds W and Z charge less. Everything fits together. The takeaway: turnover above roughly 80% screams active trading, while single-digit turnover is classic passive buy and hold. Now to parts 3 and 4, the tax cost ratios. Finally, parts 3 and 4 of exercise 2, the tax cost ratios. Again, the method is identical for each fund. We apply the formula 1 minus, in brackets, 1 plus the tax-adjusted return over 1 plus the pre-tax return times 100. Let me demonstrate with Fund X in the working box. Fund X had a pre-tax return of 10.65% and an after-tax return of 8.87%. So 1 plus the after-tax return is 1.0887, and 1 plus the pre-tax return is 1.1065. Dividing gives about 0.9839. Subtracting from 1 gives 0.0161, and times 100 gives 1.61%. We do the same for all 4 funds, and the answers appear in the table. Fund W loses 0.50% to tax, Fund X loses 1.61%, Fund Y loses 0.71%, and Fund Z loses just 0.26%. Now part 4 asks which funds are the most and least tax efficient. Remember, lower is better. The most tax efficient fund is Fund Z, with the lowest tax cost ratio of just 0.26%. And notice it also had the lowest turnover, which is no coincidence. The least tax efficient is Fund X at 1.61%, because its heavy trading generates the most taxable gains. You can see these conclusions in the green answer box. And here is the beautiful unifying lesson of this whole section. Look how everything connects. The funds that trade the most, the active funds X and Y, are also the ones that lose the most to tax, while the passive funds W and Z that rarely trade keep far more of their return. That is the takeaway. More trading leads to more taxable gains, which leads to a bigger tax bill. And this is one of the strongest practical arguments for passive investing. With tax behind us, we reach our final section, the great contest of investment styles, value versus growth. Our final section, section 6, is one of the most famous debates in all of investing, the contest between value and growth styles. Nearly every equity investor in the world leans one way or the other. Value investors are bargain hunters who buy cheap, unloved shares and wait patiently for the market to wake up. Growth investors chase exciting companies whose earnings are racing ahead. In this section, we will compare the two mindsets, look at what the historical evidence says about which wins, and learn how managers build portfolios around a chosen style. Let us settle the value versus growth question. We have reached our final section, and it is a famous and enjoyable one, the eternal contest between two schools of investing, value and growth. Almost every equity investor in the world leans one way or the other, so let us understand both. On the left is the growth investor, whose motto is buy the fast-growing company. A growth investor focuses on earnings per share, EPS, and on what drives those earnings higher. They hunt for companies expected to grow their earnings rapidly. Think of an exciting young technology firm. A key assumption they make is that the price-to-earnings ratio, the PE, will stay roughly constant in the near term. That matters because if the PE stays the same but earnings shoot up, then the share price must rise in step, which is exactly the gain the growth investor is chasing. Notice they are not very worried about whether today's share price looks expensive. They are paying for tomorrow's growth. On the right is the value investor, whose motto is buy the cheap bargain. A value investor focuses on the price component rather than current earnings, and frankly does not care much whether the company is growing fast right now. Their core belief is that the share's PE ratio is currently below its natural, fair level. In other words, the share is unfairly cheap, and that the market will soon correct this mistake by pushing the price back up. So they buy low and patiently wait for that re-rating. The gold circle in the middle reminds us these are genuine rivals. The takeaway captures the essence beautifully. Growth investors chase rising earnings, while value investors chase cheap prices that are waiting to be re-rated. But which approach actually wins over time? That is the question we tackle next. So, we have two rival schools, value and growth, but which one actually makes more money? This slide digs into the deeper logic of each bet and then tells you honestly what the historical evidence shows. On the left is the growth bet. A growth investor is essentially buying a story. They focus on the company's current and future economic narrative, its exciting products, its expanding markets, its momentum, and they are willing to pay up for that story with less regard to whether the share looks expensive on today's numbers. They are betting the future will be even brighter than the price implies. On the right is the value bet. A value investor is doing almost the opposite. They focus on the share price itself, looking for stocks trading below their worth. And they are anticipating two things: a market correction that lifts the unfairly low price back to fair value, and possibly some improvement in the company's fundamentals that the crowd has overlooked. They are betting that boring, cheap, unloved companies will quietly recover. Now, to the honest answer, in the Navy evidence strip, over the long run, value stocks have generally offered somewhat higher returns than growth stocks. So historically, value has had a slight edge. But, and this is crucial, that outperformance does not happen consistently from one period to the next. There are long stretches, sometimes many years, where growth stocks crush value, as we saw with technology stocks in recent times, and other stretches where value dominates. So neither style is a guaranteed winner in any given year. The takeaway, value has edged growth over the very long run, but in any single year, either style can dominate, which is exactly why diversifying across styles can be wise. This naturally leads to the practice of style analysis, building a portfolio to deliberately capture a chosen style, which we look at now. Once you understand that shares come in different styles, the natural next step is style analysis, which simply means deliberately constructing a portfolio to capture one or more chosen characteristics of equity securities. Instead of buying random shares, the manager decides, I want my whole portfolio to lean toward a particular style and builds it accordingly. The slide shows four common style tilts a manager might choose. The first is growth stocks, companies with above average earnings per share growth. These typically have high PE ratios because investors are paying up for their bright future, and growth managers often pair this with a price momentum strategy, riding the upward trend we discussed earlier. The second tilt is value stocks, shares that appear underpriced on the numbers, identified by low price to book ratios and low price to earnings ratios. Remember, price to book compares the share price to the company's net asset value, so a low number suggests a bargain. The third tilt is small cap stocks, where cap is short for capitalization, meaning the company's total market value. Small cap means smaller companies, and as we noted with the size anomaly, these have historically delivered higher long-run returns, though with more risk. The fourth tilt is low PE stocks, shares that are cheap relative to their earnings, which is a classic and very simple form of the value approach. Each of these is a deliberate, repeatable recipe. The takeaway, a manager picks a characteristic, whether growth, value, small cap, or low PE, and then builds an entire portfolio that tilts toward it. But you might ask, does choosing a style really matter that much? Our final content slide answers exactly that question. Before we wrap up the chapter, let us answer a fair challenge. Does an investor's style really matter, or is it just a fashionable label? The answer is that style matters in at least 5 concrete ways, shown across these cards. The first reason, style communicates information to clients. When a fund openly declares itself a value fund or a growth fund, it is telling its investors exactly what to expect, so nobody is surprised when, say, a value fund lags during a growth-led boom. The second reason, style is essential for measuring performance. To judge a manager fairly, you must compare them against the right benchmark for their style. Comparing a small cap value fund against a big tech growth index would be meaningless and unfair. The third reason, style identification enables diversification. Once an investor knows the style of each fund they own, they can deliberately spread their money across different styles, value and growth, large and small, which lowers overall risk because different styles shine at different times. The fourth reason, style allows control of the portfolio to be shared between the investment manager and the sponsor, that is, the organization that hired the manager, because the sponsor sets the style mandate and the manager works within it. And the fifth reason, style helps us watch for style drift. which is when a fund wanders away from its stated style, either intentionally, perhaps chasing a hot trend, or unintentionally, as holdings slowly change. Style drift is a warning sign that a fund may no longer be doing what its investors signed up for. So the takeaway, style is far more than a label. It shapes expectations, fair measurement, diversification, shared control, and drift monitoring. That completes all 6 sections of our chapter. Now let us pull everything together with a comparison table, a revision map, and a final word. We have now covered all 6 sections, so let us consolidate everything into a single comparison table that you can use as your one-glance revision sheet right before the exam. Read across the columns. For each approach, we show its main goal, its typical fees, its turnover and tax profile, its risk relative to the index, and the type of investor it best suits. Start with passive indexing. Its goal is simply to match the market. Its fees are very low. Its turnover and tax are low and efficient. Its risk is the lowest because it hugs the index, and it best suits cost-conscious long-term investors. Next, active fundamental. Its goal is to beat the market through research. Its fees are high at 1 to 2%. Its turnover and tax costs are high. Its risk is higher than the index, and it suits people who genuinely believe in stock picking skill. Active technical shares a similar profile, beating the market by reading price trends with moderate to high fees and trading, higher risk, best for traders who read momentum and market sentiment. Then the 2 styles. Value style aims to buy cheap shares and wait for a re-rating with moderate fees, lower turnover, moderate risk, and it suits patient bargain hunters. Growth style aims to buy fast earnings growth with moderate fees, higher turnover, higher risk, and it suits investors chasing an exciting company story. Now look down the table as a whole and notice the honest conclusion in the navy box. No single strategy wins in every situation. The right choice always depends on the investor's goals, their time horizon, how sensitive they are to cost, and how much risk they can stomach. That balanced judgment is exactly what this chapter has been training you to make. Next, let us see how every topic connects on a single revision map. This single slide is your revision map, and I want you to photograph it because it shows how every idea in the chapter connects on one page. At the very top, in gold, sits our subject, equity portfolio strategies. Everything flows down from there into 4 great pillars. The first pillar is passive management, and under it you see its 4 key ideas: the rationale for indexing, the construction techniques of full replication, sampling, and quadratic optimization. Then tracking error, which carries a little tick to remind you it is a calculation, and finally the products, index funds, and ETFs. The second pillar is active management, with its 4 branches: fundamental analysis in its top-down and bottom-up forms, the 3 generic themes, plus the 130-30 strategy, technical strategies covering contrarian and momentum, and finally anomalies and firm attributes. The third pillar is tax efficiency, covering why taxes matter, then the 2 calculations, portfolio turnover and the tax cost ratio, both ticked because you must be able to compute them, and the big lesson that active funds lose more to tax. The fourth pillar is investment styles, covering value versus growth, style analysis, the question of whether style matters, and the warning about style drift. Notice the 3 little ticks scattered through the map. Those mark the 3 calculations you absolutely must master for the exam: tracking error, portfolio turnover, and the tax cost ratio. If you can explain all 4 pillars in your own words and perform those 3 calculations, you have conquered this chapter. Let me close with a final word and the key things to practice. And that brings us to the end of Chapter 8 on Equity Portfolio Management Strategies. Take a moment to feel proud because you started this chapter perhaps never having heard of alpha or tracking error, and now you understand the two great philosophies of investing and can perform the professional's key calculations. Before you go, I want to leave you with the three calculations you must be able to do confidently in the exam listed in the box. First, tracking error, which is the standard deviation of the gap between the fund and its index. Remember to use the average differential and to divide by n. Second, portfolio turnover, which is simply security sales divided by average assets under management, a quick clue to whether a fund is active or passive. And third, the tax cost ratio, 1 minus 1 plus the tax adjusted return over 1 plus the pre-tax return, all times 100, where lower means more tax efficient. Practice each of these until they are second nature, ideally by redoing exercise 1 and exercise 2 without looking at the solutions. If you can do that, and if you can explain in plain words why a passive investor and an active investor see the world so differently, then you are ready not just for the exam, but for thinking like a real portfolio manager. Thank you so much for your attention and your effort throughout this chapter. My door and your discussion forum are always open, so please do bring me your questions. I look forward to seeing you in the next chapter. Take care and happy investing.